Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Alasdair Macleod. He is a senior fellow at Gold Money Foundation and head of research at Gold Money, and his weekly essays are posted at goldmoney.com. They are a must-read if you really want to understand not only what is happening, but why it's happening, the underlying dynamics that make it happen. And that's important, I think, because if you understand economics, and I think largely from a Austrian point of view, which is what Alasdair pretty much employs in his thought process, I think it can help you better understand what is likely to head your way in the future. So thank you for joining me again, Alasdair.
That's my pleasure, Jay.
It's always good to talk to you, and I want to ask you, primarily I would like to focus on an article you wrote on the 26th of December, Bond Worries and Gold. I would also want to get into what you think is in store for gold this year as well, because you've written about that, your first piece in the new year. In your introductory remarks on your December 26th piece, you wrote, you stated that the one that talks about bond worries. You talked about the tech. Before we get into that, I'd like to just mention, before we get into your views on that article, I'd like to just mention that Michael Oliver seems to reflect your views pretty much in terms of the direction of some of the key markets. Michael is really looking, his technical analysis is suggesting that we have turned the corner in a bear market into a bear market for the dollar and into a bull market for commodities in general. He's very bullish on gold and silver. But he comes at it from a different vantage point. I think it's always interesting when you have people that see things alike but from a different perspective. But in reading your December 26th piece, it seems that you are addressing two areas of concern. One is liquidity concerns in the dollar-based global monetary system, and the other is a lack of foreign buyers in U.S. Treasuries to fund what is a growing deficit. The United States projected to, anywhere from $1 trillion to $1.5 trillion a year need to be funded. That is new funding needs of the Treasury. So I'd like to start out by asking you, maybe address some of the liquidity concerns that you talked about in your article. And as I understand it, they're sort of related to what are deemed to be systematically important banks and Basel III requirements. Could you get into your concerns about liquidity?
Yes, certainly. This is manifest, really, Jay, with the repo market in America, which we can see continues to be extremely tight. And I think I'm right in saying that either yesterday or today, there's something like bids for repos of another $90 billion or something. I mean, there's huge, huge amounts needing to be rolled over. And, of course, we're now in the new year. And originally, the thought was that the repo crisis was a year-end problem, and it would disappear after the year-end. It's still with us, and it's telling us that the global systemically important banks, the GSIBs, which have to have enough reserves to cover 30 days commitments going forward, they're running into problems. And the problems basically are that they're trying to finance two things. They're trying to finance the requirements, if you like, for an economy in terms of bank credit. And at the same time, they're trying to finance hedge fund speculation, which basically is shorting the yen and the euro in order to buy the dollar, so that the hedge fund picks up the interest rate differential. So, it's all sort of ended up with a bit of a crisis. Now, the way it obviously gets unwound is less bank lending. And whether it's less bank lending to domestic U.S. corporations or whether it's less bank lending to the speculators and the hedge funds, we have yet to see. Certainly, if it happens that it's less lending, less availability through the repo market, because the hedge funds use the repo market as well for their activities, then that does lead to a tendency to sell the dollar and close their positions against euros and yen. So I think Mike Oliver's point about a weakening dollar, you can see on the chart there is a loss of momentum, certainly in the dollar, and that could develop further if this liquidity crisis continues, which it seems to me it will.
So the repo market is settled down now. I guess I take it from at this point in time, right? Does it seem like things have settled down?
No, it hasn't. It hasn't. This is the point. Originally, everybody was saying that there's a year-end liquidity problem, and yet the year-end has passed, and now we've still got a repo problem. There's a shortage of liquidity in the system, and the level of repos is still running at a very, very high level.
All right, so that's not very assuring to the Federal Reserve and other central banks, I suppose, because they've been shoveling lots of money into the system, and it's still not fixing the problem, apparently.
Well, that is correct. And when you bear in mind the massive explosion of the quantity of bank reserves following the Lehman crisis, I mean, here we are, admittedly 10 or 11 years later, but you would think that there's so much liquidity in the system that this problem shouldn't arise. Yet it does.
All right. So we move on to the other issue, the major issue that you have, and that is even if that was resolved, and it's not, you're telling us, even if that was resolved, you have a bigger issue, or say a longer lasting issue, and that is how does the U.S., how on earth at current interest rates does the United States finance $1 to $1.5 trillion of new borrowing needs every year?
Absolutely. The problem, basically, we can frame it like this. Normally, a government which runs a deficit would issue bonds, and those bonds, if they are issued on a non-inflationary basis, should be bought by savers. In other words, there should be savings in the system sufficient to pick up those bonds, to invest in those bonds. Now, obviously, it takes investment away from the commercial sector, but nonetheless, on a non-inflationary basis, that is what you need. We do not have that. In America and also in the UK, the level of savings is actually derisory, and most consumers don't save anymore. If anything, they draw down on credit. So we don't have the savings. So what has America been doing? Well, for the last 20 years, every year there has been a budget deficit. It has been matched broadly, which the theory says should be the case, with a trade deficit, and the surplus dollars that end up in the hands of the Chinese, the Japanese, and the Germans and everybody else, all those surplus funds should be reinvested back in America. Now, that way, you have a stable dollar, and the U.S. Treasury finds that it has funding. The origin of that expansion, if you like, of money that ends up abroad is itself inflationary. But it is less inflationary, perhaps, than a situation where the Fed just prints the money and gives it to the government, which is more or less what quantitative easing is doing. Mm-hmm. Quantitative easing also has the advantage of, injecting capital into the banks in the form of reserves. So you kill two birds with one stone. You fund the government and you fund the banks. But it's all inflation. And this is now what is happening. I mean, repos or QE, it really doesn't matter. What's happening is that the Fed is having to pump money into the system to stop it falling over. Now, the foreigners, basically, because global trade is now contracting, partly as a result of the credit cycle turning and partly as a result of the tariff war between America and China, you can see that the funds are not going to get recycled to finance that increasing budget deficit. I mean, the Congressional Budget Office reckons that this current fiscal year deficit will be over $1 trillion. If I am right, and we are heading into a global recession, the effect on the American economy is likely to drive that deficit, that budget deficit, up to the other figure you mentioned in your preamble of $1.5 trillion. So, this is the problem. It's all going to be done on printed money or printed credit from the banks, one way or the other.
Yeah, well, and we've gotten used to that. So a lot of people are saying, "What's the big deal, Alasdair? What's the problem?" I mean, for the longest time, it's been said that we've been able to live beyond our means. Americans have, because of the kindness of strangers. That is, foreigners are been willing to buy our treasuries. So I think you touched on some of the issues of foreign trade, the tariffs and that sort of thing, sort of reducing trade, and so the flow of dollars back into treasuries. There are some geopolitical issues too, though, it seems, that might be in play, as well as the funding needs of the biggest creditor nation was China. Can you comment on some of those issues, those dynamics that may be coming into play that are going to make it more difficult? I mean, I saw that somewhere, I think in your article you mentioned August of last year. I think I saw since September up until the last months of 2019 that 90% of additional U.S. Treasury borrowings were financed by the Fed. So where does that leave us? I mean, what are the geopolitical issues that may be coming into play that make this, causing a tectonic shift here in the global markets?
Well, we have the problem, if you like, even before we consider geopolitical issues, because the key point is that with a contracting economy, people do not need to own so many dollars. And I'll just give you some figures which will put into context. Foreign ownership of assets in US dollars and in America, a total around about $24 trillion, of which about $3.5 trillion is deposit money in the corresponding banking system. If you look at the Americans' investment in foreign jurisdictions, their investments total around about $11.5 trillion. Now, that's a lot less than the $24 trillion that the foreigners own in US dollars, one way or the other. Now, if you look at the bulk of that investment abroad, the liquidity side of it is actually in dollars. In other words, this is a situation where Americans will lend money, say, to Malaysia, but it'll be a dollar loan. So, there's no currency situation as far as the Americans are concerned. There's just, a sort of, if you like, a loan risk. The total amount, looking at the tick figures, the total amount of foreign obligations denominated in foreign currencies is only $92 billion.
$billion, yeah.
Yeah, $1 billion. That compares with the foreigners having $3.5 to $4 trillion of dollars. So, when the global economy slows and money starts to go back to home, guess what's going to happen? The dollar's going to go down. So coming back to your basic question, and that is the geopolitics, the Chinese have played a game, I think, of not being provoked. They have made some very bad mistakes. I think they made a very bad mistake over Hong Kong. Really, they had no need to try and introduce those extradition laws and give the Americans the excuse to attack the lack of democracy in China. So, yes, they have made mistakes, but by and large, their approach on this is not to rock the boat and just let the American dollar hang itself. The Russians, I think, are probably more aggressive. You can see that in their reserve policy. They basically ditch every dollar they get and turn it into physical gold. The Chinese, they sort of tinker around the edges a little bit, maybe giving a little bit of a signal here, a little bit of a signal there. But really, they're not going to be provoked. Now, having said that, we've got a new situation in the Middle East, which I think is very, very disturbing. And it seems to me that this could draw in into a wider conflict, particularly involving Israel, Hezbollah. Russia has got great interest in the area as well. China, again, is tending to sort of, she will work with Russia through the UN, but she won't do very much more. So really what we have, until further notice, is a situation where the dollar is killing itself. It's not the foreigners killing the dollar.
Yeah. So it seems to me that what you're suggesting here then is that the Fed, if the Fed has to print all the money, the Fed has to keep printing in order to finance the U.S. deficit. There's going to be a loss of confidence somewhere in the markets, and the financial markets are going to start to see what is really going on, and they're not going to want to hold dollars anymore. They're not going to hold treasuries, I guess. And then if you continue to drive interest rates lower, and Mr. Bernanke yesterday was weighing in with his notion that we should actually go into negative rates, and you had pointed out on this show before what that would mean for the world's reserve currency. Very bearish for the world's reserve currency because of this whole notion of time preference. So those dynamics seem to be very much in in order. I mean, if the Fed had to come in and buy 90% of our treasuries since September, it means they had to do that in order to keep interest rates suppressed so that the whole thing wouldn't fall apart, right?
Well, I think more importantly, they have to do it to keep the U.S. government funded. That's the real problem. But getting back to the basic theme of what you were saying, I think that this year is the year when the frailty of the fiat money system is going to be exposed to the markets. I mean, we're already seeing this in the gold price. I mean, the action in COMEX is really quite extraordinary. I mean, we've got open interest has rocketed up to nearly 800,000 contracts. The highest we ever had it before was 630,000 contracts, and that was regarded as extreme. I mean, if you were getting over 500,000 contracts not too long ago, that was a pretty overbought market. Now we're at 800,000. We must not forget that each contract has a short and a long. So if there are 800,000 contracts outstanding, then that is roughly 2,500 tons of short positions. There are also long positions against it as well. But to me, one of the great clues in the last quarter of last year was at the very end of November, when the December contract was rolling off the board. There was one day where there was a switch from the December contract into the next active contract of 110,000 contracts. I've never seen such a large single-day movement. And, until that happened, I thought, my goodness, we're sitting on a precipice here. But there's a whale in there with a huge, great position. Now, that whale does not have a position which presumably approximates to 10 million ounces. That is something you do not do unless you have some very, very good information or you are absolutely confident in what you're doing. Now, this was happening basically just as the repo business was beginning to go wrong. Now, that tells me that there are players in the market, insiders who really do understand what's happening. And the reason that the bullion banks haven't bashed the market back to try and shake out speculators as stop losses get triggered and all the rest of it is, the buyer is in there absorbing anything on any dip. And sure enough, I mean, it was okay. We had this Iranian thing over last weekend, which drove the price up briefly to 1580 or 1590 or something. But even if that had not happened, the way the gold market was going, it was telling us that there's something very, very wrong in the fiat currency world. And I see this continuing. And I would sum it up by saying 2020 is going to be a year of discovery for those who think that fiat currencies are all tickety-boo and it's all going to be wonderful.
Well, Alasdair, that's a lot of gold and a lot of paper gold contracts. If people start to demand delivery, what's going to happen to the gold market?
Well, I'm not sure they'll start demanding delivery. I think we're looking at hedge funds. We're looking at very, very big dealers in paper, basically, and I think they'll just roll their positions as long as they wish. They'll probably wind it down at some stage during the year, but I think the whole thing is changing so rapidly, and there is a growing appreciation, I think, in the investing public that there is something wrong with the dollar, and if the dollar starts going down, as the technical analysis suggests, then I can see real blood in the streets. The other aspect of this, which we haven't touched on at all, of course, is what happens to bond yields. I think bond yields are going to rise this year, and I can easily see the 10-year government bond yield rising to over 3, 4, possibly even 5%. Wow. Now, if that happens, then basically U.S. government finances are screwed.
Yeah, well, indeed. I mean, the Powell pivot took place when rates were rising below, I don't know, I don't think the 10-year got to 4%, or did it? I don't think so. So, I mean, then, the equity market started having real problems before tons of money was pumped in there by Mr. Powell. So, Alasdair, with just about a minute and a half left, you wrote an article, Gold's Outlook for 2020. I think you just touched on it. But could you give us a real quick summary of what that article is? And then people, of course, can go to Gold Money and read the entire article.
Yes, it's all about the effect of inflation on fiat currencies, particularly the dollar, and the way the dollar is going to get hit, if you like, in terms of its purchasing power. I think 2020 is the year when this really becomes very, very obvious. The other thing I did in that article is a lot of people tell me that higher interest rates are bad for gold. I illustrate in that article why higher interest rates are not bad for gold. Mm-hmm. And I particularly focus on a situation which I think is very similar to the one we face now, and that is what we faced in the UK between 1970 and 1974, when bond yields on the long end rose from something like 7% to, I can't remember offhand, but it's something like 11 or 12%. And at the same time, gold rose from £14 to £80. Mm-hmm. Are higher bond yields bad for gold? No, they are not.
No. Well, and indeed, again, another issue where you and Michael Oliver are in agreement with and that is the potential for rising Treasury rate markets this year. We'll have to leave it go at that, Alasdair. Thank you so much for being with us. It's always a pleasure. And people just go to goldmoney.com to read Alasdair's weekly essays there. They're very, very important and very insightful in helping you understand what's really going on in the financial markets. Thank you so much, Alasdair.